Okay, it's my pleasure to announce Jim Paterba, who's the chair of the economics department at MIT. Jim and I go back about 30 years, getting up to that much. He was a Marshall Fellow, is that right?
Mm-hmm.
At Oxford when I spent a year there, and so I've known him for a long time, and he's one of the world's experts on the U.S. tax system, something near and dear to our hearts. When he was coming to California, he said, well, should I talk about retirement or should I talk about fiscal management in the government? And I said, well, why don't you talk about taxes? Because that's something everybody in California is very focused on these days. So Jim's going to tell us about the AMT.
Great. Thank you. It's a tremendous pleasure to be with you this morning. What I would like to try to do is to give you some insights on how tax policy economists think about the design of tax policy and to weld that together with a discussion of a particular tax planning problem that a number of you may have, which is dealing with the pernicious alternative minimum tax and deciding exactly why it's here and what it does to your personal tax liabilities. I know the AMT in various vintages has been a bit of an irritant here in Silicon Valley in the era of the late 1990s, 2000, 2001. There were issues about the way option income was taxed under the AMT that created a lot of problems for a lot of people. We've moved beyond that, but the AMT remains, not just here in Silicon Valley and in California, but more broadly, a fundamental challenge to tax policy design in the United States. And what I'll try to give you this morning is an overview of where the AMT came from, okay, why we have this rather unusual tax, what some of the current patterns of the alternative minimum tax look like, who pays it, how you end up paying it, why Californians pay it more than most other residents of the U.S., and then I want to talk a little bit about what one can do to fix it. And the real challenge in some sense is going forward, talking about what may be coming down the road in tax policy and how one tries to address, in a political sense and in an economic sense, the different options available for working with a challenge like the AMT. I'm happy, by the way, to be interrupted as we go along. If there are questions people would like to ask, happy to make this quite interactive as we proceed. Okay, so let me start with a little bit of the history of the alternative minimum tax. Okay. In 1969, at the very end of the Johnson administration, the Treasury Department had done a study of people who had what seemed like a lot of gross income on their tax returns, but who ended up paying virtually nothing in taxes, okay, or literally zero in taxes. Now, how could that happen? Say, for example, you were someone who made large gifts to charity. Right? That could, in some situations, mean you had a lot of gross income, but you ended up with a very low bottom line of taxable income. Say you were someone who had foreign tax credits for income abroad. The tax credits might zero out your U.S. tax liability in some settings. So big top line, small bottom line. The sense of the politicians who were presented with statistics on how many taxpayers had large gross but virtually no tax liability decided this was an unacceptable situation. And how were they going to fix it? Well, the skills that they had available for fixing this complicated, linear programming problem where you're adding together and subtracting lots of numbers were not quite as good as those of the Google workforce. They decided they wanted to make sure the bottom line was a number bigger than zero, so they were more or less going to require that the bottom line had to be bigger than zero. How were they going to do it? They were just going to define this alternative thing, which was going to be a different tax, which disallowed some of the deductions that got people down to zero. They were going to put a different rate on that, and that would sort of get them this thing, which eventually would become the alternative minimum tax. So it was a very crude fix for the problem of some people don't pay taxes. Okay? And at the beginning of the time that we had the alternative minimum tax, it was really a little wrinkle in the tax system. 20,000 people paid the alternative minimum tax in 1970. So while I'm sure for those people it was a bit of a nuisance, for the broad population it really wasn't an issue at all. In 1982, the modern structure of the AMT was created in some of the tax reform legislation that was enacted during the Reagan era. And then in 1986, which was a watershed year for tax policy in the US, when we really changed the nature of tax policy, broadening the income tax base, lowering the rates, the AMT that we currently have was basically put in place. The key thing that happened in 1986 was one thing that economists had been beating on decade after decade in the tax system, which is we need to avoid the problem of inflation, which we had in the 1970s, right? 8% a year, 10% a year. With inflation like that, even if your income doesn't rise in constant dollars, because inflation pushes you up in nominal dollars into a higher tax bracket, people could often see their tax burden rising substantially through what was called bracket creep. Okay, so in 1986, finally, the Congress fixed this problem by indexing all the numbers in the income tax schedule to inflation. So they automatically moved up the bracket amounts year upon year. The one thing they didn't do was they didn't index the alternative minimum tax provisions for inflation. And even though inflation has not been a big deal in the US economy in the last 2 decades, every year, cumulatively, you take away 2–3%. Eventually, over time, it starts to build up. So the big thing that happened is that between 1986 and the early part of this decade, inflation eroded the parameters of the alternative minimum tax, while the rest of the income tax schedule was moving along indexed. Okay? Now, the way the AMT works, and I'm going to say more about this in just a minute, because I'm going to try not to say lots of detail about tax accounting, because I know that that's even less riveting than the subject of tax politics and tax economics. Okay? But the way the alternative minimum tax works is that you do a calculation where you compare what your tax liability would be under the alternative minimum tax, what your tax liability is under the regular income tax, and you decide which one's greater. If the AMT is greater, you pay something above what your regular tax liability would be. Okay? Well, that means that you can have a lot of people paying AMT either of 2 ways. If more people are paying AMT or fewer people are paying the regular income tax, because the 2 schedules have to be compared. Many of you remember in 2001, we embarked on a period of substantial tax reduction in the income tax. And the 2001 tax cuts, coupled with some of the subsequent changes in tax policy, reduced liabilities under the regular income tax, which means that many more people were finding themselves in a position where the AMT was the greater of the 2 taxes. Okay? The result of the non-indexing of the AMT and the 2001 tax cuts are that by the time you get to 2006, there are about 4.5 million people paying the alternative minimum tax. That's out of a pool, as you'll see in a couple of minutes, about roughly 100 million people who pay taxes in the US economy. Okay? However, in 2007, if the Congress does not do anything to change the rules that are currently in force, almost 30 million people are going to be paying the AMT. Why? What Congress has been doing is year by year, even though the AMT provisions aren't indexed, it's been fixing the AMT to put in higher thresholds than the law usually allows. It's in effect been doing a year-by-year adjustment and patching of this tax. Okay? They have not yet passed a patch for 2007. So maybe they'll get it together to do it. Maybe they won't, but if they don't, over 30 million people are going to be paying the AMT when they file their 2007 tax returns. Okay? This will produce a huge amount of excitement in tax policy because that will actually create the outcry to do something about this going forward.
So do you know what the 30 million number would have been in 2006 without the patch?
25 million in that range. So it's kind of moving up pretty slowly. Okay? I tried to get some sense of how exciting the AMT is for the average person in the internet economy. I typed in alternative minimum tax and found that I got 1.74 million entries. I don't know whether that's a big number or a little number in the grand scheme of things. If you type in AMT, you get a variety of other things which are not related to the alternative minimum tax. And the alternative minimum tax is, in fact, not the most common AMT answer that comes up when you look at this. Okay? The AMT is, in fact, moving into something, though, which is getting more and more discussion in the popular parlance as something people are thinking about with respect to tax policy. I had the privilege to serve on a presidential tax panel in 2005 that was designed to make recommendations for how to reform the income tax code. And we actually took the view that the AMT was one of the key problems we had to fix. And we proposed a set of reforms which would actually eliminate the AMT and change other pieces of the income tax schedule to pay for that. That reform went nowhere and doesn't seem likely to go anyplace going forward. But I think a constant issue that we'll talk about this morning is how much political pressure will emerge as a way of trying to change the structure that we have in place. All right, this is the point when I have to do a little bit of explaining how this tax works, just so you'll get some sense. Actually, how many of you have filed taxes when you've ended up paying the AMT? Okay, so this is a group. I thought this was going to be a group that was more than the standard California population, and you're in the right income groups and in the right situations to face this. All right, the way the AMT works is you start out with taxable income as calculated under the regular income tax. Okay? And then you add back a couple of deductions that you currently can claim under the income tax, but that are not allowed under the AMT. The big one for most people here is probably the state and local tax deduction, since California is a high tax state, and that basically takes back a lot of deduction for many people. Okay? You then add in unreimbursed business expenses, some other miscellaneous deductions, medical expenses that are below 2.5% of your gross income, and that gets you something called the alternative minimum taxable income, almost. Okay? The almost part is that in addition to what I've just described, there are many, many other special provisions, about 50 other special provisions that define AMT income. Okay? Now, for many people, the vast majority of US taxpayers, they're not issues that confront them. But there are things like partnership income or investments in special kinds of tax-favored activities, which are disallowed under the AMT, but are allowed under the regular income tax. Okay? The consequence of changing all of those provisions is that people who have complicated tax lives to begin with end up with much more complicated tax lives under the AMT because they have to keep track of these various special types of provisions. And some of the treatment of the income on incentive stock options is an example of one of those special provisions where the tax rules that are applied under the regular income tax in terms of the timing of the recognition of income are different under the AMT, and that consequently leads to a different calculation for somebody who's generating some income through that source. Okay? And this is important because it leads to one of the big complaints about the AMT, which is there's a lot of complexity here that taxpayers are forced to deal with. Okay? Once you've figured out what your alternative minimum taxable income is, you basically, or to figure out your alternative minimum taxable income, you then subtract an exemption. Okay? And the exemption is currently $45,000 for married joint filers and $33,750 for singles. Okay? But, and here's the part of what Congress was doing in the previous years, in 2006, Congress bumped this up to $62,500 and to $42,500. And that bump is enough to take 25 million people out of the range where the AMT is greater than the regular tax. Okay? Now, just to give you some sense of how this works, and in this audience, I know that this picture will actually sort of explain what's going on. These are the two schedules. Okay? The blue line is the regular income tax. The brownish line, the reddish line, is the AMT. Okay? And the reason that at high income levels, notice this scale is scaled to Silicon Valley. Okay? This is from 0 to 100 to $1 million of adjusted gross income. This is not where most of the US population would look if you were drawing the schedule of tax liabilities. But okay, the regular income tax has a top rate of 35%. Okay? If you get enough income, you're going to end up with more tax liability under the regular income tax than under the AMT because the AMT's top rate is 28. Okay? So at very high incomes, you end up out through the top of the AMT schedule. You pay regular income tax. At the bottom, the exemption amount for the AMT is much larger than the exemption amount for the regular income tax, even without a congressional fix. So you end up with no big deal there. You pay regular income tax if you pay anything at all. The thing, though, that's critical is that these two curves are very close to each other. Okay? These are calculations, by the way, that were done by the staff at the National Bureau of Economic Research in Cambridge. Dan Feenberg, who's worked with me on tax policy projects before, did these calculations. And what you see is that these are curves that cross and are very, very close to each other for a significant part of their range. So that you end up with a situation where the regular income tax, the blue line, is greater than the AMT until an income of around $50,000. Then there's a range where the regular tax falls below the AMT until you get up to a place that is around $300,000, and then you cross back over and you're on the regular income tax beyond. Okay? But the critical thing is if you just think about shifting the curves a little bit, right? A horizontal shift in where you leave the x-axis on the AMT curve, which is what you get by displacing that exemption a little bit, is going to have very dramatic consequences for the number of taxpayers who are on the AMT versus the regular income tax. And that's why what seems like almost a discontinuous change, which is going from 4.5 million to 30 million, can happen if you don't change what these exemption levels look like, because you've got lots of people who are very close from one to the other. Okay? The other thing that means is that there will be many taxpayers who are not paying that much under the alternative minimum tax, but who are nevertheless in the AMT regime. Okay, the increment to their taxes is not that great relative to what they would be paying under the regular income tax, but they have to go through the calculation of the AMT because they've ended up facing that as the higher burden. Okay, so one of the key things to think about here is just how do these rate structures look. The AMT is basically a two-bracket tax It's a piecewise linear schedule, 26 and then 28 depending on the income amounts. But it's got some phase-outs in it. These are one of the things that the folks who design tax policy don't really know what E and pi are in most cases, but they know how to design linear schedules that can do all kinds of strange things. And one thing that they like to do is they give you an exemption at the bottom, and then they phase it out at some place over some income range. Okay? What that has the effect of doing, if you claw back the initial income exemption, is it makes the effective rate that you're facing during the clawback range higher. So although the law says the rates are 26 and 28, in fact what happens is that we've got, because because you lose 25 cents of an exemption for each dollar of income in some ranges, you end up with rates that are higher with 32.5 and 35 over some significant parts of the income range. So many people, as I'll show you, end up facing a higher marginal tax rate with the AMT than with the regular tax. Okay? And significant and growing numbers of these AMT payers are facing the phase-out ranges as opposed to the regular ranges. Okay. What are the implications of this AMT structure as we think about what's happened in federal tax policy in the last few years? Okay? And again, just to give you a thumbnail sketch of what went on, federal income taxes and federal taxes as a share of GDP are today, federal taxes overall are around 20% of GDP. Okay? During the late 1990s, federal taxes rose to close to an all-time high by a percentage point or two relative to where their average has been in the post-war period. The 2001 tax cuts took that percentage back down. Okay? And in the process, they reduced the reach of the regular income tax schedule, throwing more people into the AMT. But okay? You have to think for a minute. If the AMT was out there and people were now paying the AMT, which they wouldn't have done otherwise, that means that they didn't get the full amount that, in some sense, the 2001 tax cuts would have otherwise delivered for them. And that's absolutely right. So one of the issues that we'll talk about in a few minutes is that some taxpayers who were thrown into the AMT as a result of those 2001 cuts, in fact, saw some of the tax benefit clawed back as they went forward. Now, one thing that's really important about U.S. tax policy at the moment is that these 2001 tax cuts, okay, and for some of you, these are rates are things that change the rate structure on the regular income tax. We went from 39.6 as a top rate down to 35 as a top rate, and 36 down to 33 as the next bracket amount. So many people may be facing some of the bracket ranges that are affected by that law. But the way Congress deals with the budgeting problems of enacting tax bills, they have to try to make sure they're satisfying certain revenue and deficit targets when they do it. Okay? The consequence was that when we enacted the 2001 tax bill, it was not a permanent change in U.S. tax policy. It was rather enacted as a temporary change with an expiration that was originally going to be between 2007 and 2009, and now is going to be in 2010. Okay? So all of the things that happened in the 2001 bill could vanish when we get to 2010 if the Congress doesn't reenact that. Now, you may have noticed that 3,000 miles away, there's a different complexion to Washington today than there was in 2001, maybe even more different by the time we get to 2009. And the result is that it's not at all clear what will happen with the tax legislation that was put in place on a temporary basis in 2001. So a big challenge, and we'll see how this is very important for the forecast of what happens going forward with the AMT and the rest of the schedule, is do we think we're going to see the extension of those tax policy rules, or will something different happen? Okay, and the way this matters for your own personal planning, if you're thinking about, do I want to do something which has the effect of generating income now or in 2008 or in future years, right? Some of you probably have some opportunities about choosing when to make charitable gifts, right? Charitable gifts are negative income for this purpose. Choosing when to realize income. I don't think there's anybody here, maybe except for Hal, who could think about withdrawing money from an IRA or a 401k plan. But if you were in that range, there's a question about when you want to pull money out of a retirement account. It's going to be taxed at the prevailing rate. And if rates are going to be different after 2009, obviously that's a margin on which you want to think about where you would do this in terms of your own personal tax planning and thinking. So, okay, so that gives you at least, I hope, a broad architecture of what's involved with the AMT. I wanted to do a quick calculation for you of the clawback issue. And sometimes people say, well, the tax cuts weren't as big as they were promised to be. I've never been quite sure what to make of that argument. No one promised anybody a particular tax cut. There were changes in the tax law. The effective The effect of the tax law change was not as great as it would have been in the absence of the AMT, but it still changed the liability that people faced. This just shows you percentage of taxpayers these are different amounts of cash income, okay, to give you some sense of where the U.S. income distribution is. This is for the whole country. And percentage of taxpayers in different places, and then the clawback percentage. The clawback percentage is the amount of the tax cut that would have gone to people in that income range as a result of the 2001 change that was taken back by AMT liability along the way. Okay? So for people in the 75 to 100K range, those are folks who not many of them are facing the AMT yet. Okay? About 20% of the amount of the tax cut they would otherwise have gotten was pulled back by the AMT. But you get up to the 200 to 500K group, those are the folks who are right in the thick of the AMT region right now. And for them, the AMT has been a very, very important factor, because the fact that AMT is above the regular income tax means that you can shift around the schedule of the regular income tax. It doesn't change your tax liability because you're facing the AMT, not the regular income tax. And that's essentially what happened to these folks, to the tune that nearly 70% of the tax cut in that range was actually clawed back as a result of the AMT. The brutal reality is that if we do not change the exemption levels for 2007, 2008, 2009, effectively, for taxpayers with incomes between about $100,000 and $500,000, the AMT will overwhelmingly become the tax schedule under which you pay taxes. Okay? So the rules that you would want to become familiar with in terms of understanding how you are taxed by the federal government would be the AMT rules and not the regular income tax rules, simply because most people in those ranges will be facing the AMT going forward. Now, that, of course, raises the question of which is a better tax schedule. Is the AMT a better tax schedule or the regular income tax schedule a better tax schedule? Neither of these tax schedules are what a group of economic theorists sitting down to design an ideal tax schedule would probably grind out as a result of their calculations. So you have to decide which is the best of these second best alternatives. And we'll come back a bit at the end and try to say a few things about that question. Okay. This chart just shows you how the number of AMT taxpayers will grow under projections going forward. Okay? And I've done two things. The first two columns just show you, this is the number of people who file tax returns. Okay? So in 2007, we're projecting about 137 million people. A bunch of these people are people like my 18-year-old son, who had somebody withhold some taxes on his summer job. He's going to file a tax return to get it back, but he's not going to pay any taxes. Right? Set of people who have positive tax liability is about 100 million. Okay? And it's important to recognize there are a lot of these extra returns around that aren't quite what you think of as tax-paying households. Okay? Fraction of those people who are going to pay AMT in 2007, it's about 30%, because we're projecting 30.2 million households. If you extrapolated the California experience, okay, and this was just, we did a simulation where we took taxpayers who were in California, and we basically said, what if the whole country was like California, right? Sort of like the old Beach Boys tune, Turn to Tax Policy. Wish they all could be California taxpayers. And if they were all California taxpayers, they'd only be about 30.8 million, not a big change. Notice, however, that in earlier years, the percentage jump is much bigger. Why? Because in 2006, for example, when you have nearly a 20% or 25% increase if everybody was like California, it's because when the exemption levels are higher, the California higher taxes have a bigger impact in kicking Californians into the AMT than the lower taxes in much of the rest of the country. Okay? And similarly, you see other differences which are larger. By the time you get to the 2007 to 2011 period, what actually happens is that the differences aren't that great because many, many more people in other states are facing the AMT. Notice that there's a big change between 2010 and 2011 in these projections. Why? We projected this using the actual law that's on the books, which means that in 2011 we go back to the pre-2001 marginal rate schedule for the regular income tax. People's ordinary income tax is higher. The result is the AMT burden is smaller, and consequently you see a significant drop in the number of people who would be paying the AMT at that juncture. Okay? And this is just designed to give you some sense. It's one of these situations where there's a big drop depending on what you assume in 2011. These are numbers compiled by the Joint Committee on Taxation. They just show you that the red line, which assumes that you extend the 2001 law beyond 2010, in that case, you look at these projections which go out to 2017. There are 51 million taxpayers by that point who are facing the AMT. Even if you do extend the tax change, the tax cuts, you see a drop in 2011, but then this inexorable ongoing increase. And the reason, of course, is the non-indexation. It's that the little bit of inflation year upon year grinds you forward in putting more and more people into the AMT regime versus the other regime. Okay? There's a statistic that you sometimes hear that I want to illustrate for you, which is that it would be cheaper to repeal the regular income tax than the alternative minimum tax after a couple of years. Okay? And that turns out to be true. But let me just explain what that means. Okay? Here's the total income tax being collected by the combination of the regular income tax and the alternative minimum tax. In 2007, that's a little bit over $1 trillion. Okay? Just, since you're not all economists, the US GDP is about $13.2 trillion. Okay? So, you're picking up something on the order of 1/13, 1/12 of the economy in terms of federal taxes at this point. Those of you who know that a lot of taxes are collected not through the federal income tax. The other very big tax, of course, is the FICA tax for Social Security and the associated tax for Medicare. You add the FICA, Social Security, and Medicare together, you're up to around 20% of personal income, and you get almost another $800 or $900 billion from those taxes once you throw them in. Okay, AMT in 2007, about $100 billion. Okay, regular tax, 94.6. Okay? You add these two things together. You add regular tax together with AMT, and you get the total tax. The 99.9, sounds like we're having it on a special, right? 99.9 today. The 99.9 number for the AMT is the amount of AMT people pay beyond what they pay in ordinary income tax, because that's the way this thing works, right? You calculate the excess, and you then throw it in. Okay? But notice that the AMT liability, if the only tax law in the land was the alternative minimum tax, and you didn't have the regular income tax anymore, that's 97.8, which is actually more than the regular income tax liability at the moment. Okay? So that is the sense in which if you repealed one of the regular income tax or the alternative minimum tax, you would end up collecting more revenue if you repealed the regular tax than if you repealed the AMT. Okay? That is not to say that if you repealed the AMT right now, okay, you would lose most of the tax revenue. You would not. You'd lose $100 billion in 2007, right? But the relationship between the AMT and the regular income tax schedules is such that the AMT applied to everybody would actually collect more revenue at this point than the regular income tax applied to everybody. Okay, so I just want to clarify that because it's a statistic which is sometimes bandied about in some of these discussions. Okay. This is just designed to again illustrate for you where the AMT is kicking in. It basically makes the point of some of the earlier slides that I showed you. This is looking at 2006 and 2007, where the sort of fraction of people in different income categories who pay the AMT are. And what you see is that, and this also highlights for you where the action is coming from in that 2006 patching that was done. Okay? You look down the income spectrum. You see that in the 200 to 500 range, 2006, about half the taxpayers paid the AMT. That goes to 90% in 2007 if we don't fix the situation. Lower down in the income distribution, larger proportional changes, but smaller absolute changes. In 2007, about 9% of people in the 50 to 75 range are paying this tax. But it's really those folks in the 75 to 100 and 100 to 200 who get socked with the AMT if we don't do something to fix it in 2007. Okay? And that, it's that group which sort of is we're beginning to cut into parts of the income distribution here where the notion that they are very high income taxpayers escaping tax liability doesn't quite wash. Okay? There are two examples that I'm not sure, I've actually haven't verified either of these, but I've been told that it is possible that if the S-chip bill, the expansion bill for children's medical insurance that was just vetoed by the president yesterday or today, had gone into effect, there were households who would have qualified for children's health insurance under that program who would also have been paying the AMT in some situations. And there are some households apparently who qualify for something called the Earned Income Credit, which is a wage subsidy program targeted at lower income, lower earning households. That it is possible in the current environment to actually face the Earned Income Credit, which is trying to subsidize you for entering the labor force, and actually be trapped by the AMT at some point along the way. So, this is kind of the disconnect between different parts of the population and thinking about, we're not quite managing to get the targeting to work in the way that we had originally designed this thing for. Okay, and that I think sets up the question of what do you do with respect to the taxes. Now, in terms of what do you do, a very important question is just geographically who's actually facing this tax. This chart, which was put together by the Tax Foundation based on 2003 data, shows you the percentage of taxpayers in 2003 by state who were facing the AMT. And you see that here in California, with 4.5% of your taxpayers facing it, that's a high number. New York is at 6, New Jersey's at 5.9, Connecticut at 4.8. Okay? This is an example, of course, of not holding everything constant. I mean, these statistics are true, but I think what you'd sort of like to ask is not what fraction of all taxpayers in the states are doing this, but rather holding constant the kind of taxpayer you are. If I plop you down in different states, what's the probability you're going to face the AMT? And that hinges more on things like what your state tax liability will be than on simply which state you're in. Part of what drives these things is simply the underlying income distribution in the different states, right? There are many fewer people in the $100,000 to $200,000 income bracket in Mississippi as a proportion of the population than there are in California or New York. And since those are the regions where the regions of the income space where you tend to face higher AMT, that's the groups that are going to pay it. Yes, sir?
Well, I was going to ask about what is the red and the blue, but I see it there.
It's just that the blue is just the top 10. So it is not, there's no connection to the red state, blue state political discussion. Although there is a pretty strong correlation, right? And that, in fact, turns out to be important, potentially, for understanding the chances of making headway on this, right? Because the income distributions in the states that show up as blue tend to be the states that have a particular political spin in many cases. That undoubtedly complicates the problem of trying to make some headway with respect to the AMT. OK. The remainder of what I want to do is to say a little bit about why the AMT is a burden, and then how one thinks about the problem of going forward to fix this all. Okay? And I want to do more than just talk about the nuts and bolts of taxes with you. I want to do a little bit of economics before we're done, which is to sort of ask the question, how do economists think about tax systems, and what looks good and what looks bad from the standpoint of an economist wrestling with these issues. All right, first, the issues are, what's the bad news here? Why is AMT such a problem? Especially at a place like Google. Okay? I have always been, I should explain, I have always been deeply unimpressed by the argument that it requires doing more calculations when you get to the tax schedule, right? Well, especially once people are in some computerized software program for doing their income taxes. The additional burden of redoing the calculation that was on my very first slide, which is to say, take taxable income, subtract from it, or subtract from it some items which were already included, add back to it something like your state and local taxes, recalculate 0.26 times that, and compare with the previous number, right? There are people here who probably on your BlackBerries have programmed that before I finished saying the sentence, right? So it's not a big deal to do that calculation. The burden of the AMT comes if, first, for the taxpayers who are not doing it in a computerized fashion, there is the question of going through and doing a second set of calculations, which might be burdensome. Second, there's the issue of having to think about which tax schedule you are on. And I think that's the bigger one, that there are essentially parallel universes in which you could be taxed, and you're not sure which one you're in. Now, I'll give you a simple example of where that turns out to complicate life a lot. Many of you probably have, confront the problem of do you itemize deductions or not itemize when you do your income taxes. My guess is most people end up itemizing because of the relatively high state income tax burden in California. But many taxpayers in other places do a calculation where they add up their itemized deductions, compare it with the standard deduction, and decide, do I itemize or not? You get an answer, right? Do I save taxes by itemizing or not? And that in a one tax system world, it tells you what you're supposed to do. In the world where you have to look at the AMT and the regular income tax, it is actually possible that even though it made sense for you to take the standard deduction because it was greater than your itemized deductions under the regular income tax, if you're going to face the AMT, you should have itemized your deductions instead. You should have done something which looked silly on the regular income tax, which is to be an itemizer, even though that didn't make that made your regular income tax greater than your income tax had to be. And that would actually, because you were then, you're going to kind of go to a if statement, and you're going to go down the if down into the AMT bin. And in the AMT world, you're going to save taxes by having chosen to itemize on the regular income tax along the way. Okay? That's a kind of screwy decision logic to put people through as they're trying to figure out what their tax liability will be. And it's part of the complexity that comes along with all of this. Okay? The second thing it does is the AMT, once it's kind of, it's kind of like, something it's an absorbing state. Once you go into the AMT, even if you don't pay AMT the next year, it turns out that you are no longer free of the AMT world, because there are some carry forward provisions associated with the AMT, which is that you're allowed in future years to claim back the AMT that you paid if you don't have much AMT liability going forward. And the result is that it's complicated enough to keep track of all the record stuff that you need for your tax liability in any one year. But now you have to actually link the two tax years or many tax years together. So the AMT is fundamentally more complicated because there's this relationship between the taxes this year, the taxes next year, and you end up sort of with this multiplicity of issues you have to sort through. Okay? Leaving aside the question of, your tax rates may now change more from year to year than you would have thought they did otherwise, because you could jump back and forth between the AMT schedule and the regular schedule. Potentially, that means you're jumping between a tax rate of 35 or 33 versus 26 or 28 or the other phase-out rates which are associated with the AMT. For the kind of things that a lot of accountants and tax planners do, where they're trying to offer their clients advice on what's the best way to take advantage of your tax planning opportunities, the uncertainty that's associated with what's going to happen to you from year to year is very detrimental to the activity they're trying to carry out. And that poses some serious issues. The final problem with the AMT, at least the final one that I'll mention, really comes up for these folks who face the special tax provisions, the 50-odd things in the list that can trigger AMT liability, but are much more complicated than your state income taxes or whatever. For those folks, the AMT really does involve an additional burden, because you have to keep track of the part of your municipal bond interest which is taxed by the AMT, the part of your home mortgage equity line which is not deductible under the AMT but is deductible under the regular income tax, things like that. And there's a pure record-keeping, additional information and document procurement issue that one has to wrestle with, and we don't basically do that in the standard setting. So this creates a set of factors, all of which compound to create some burdens for people with AMT liability. And I'm not going to say a great deal about the details of which provisions kick people into the AMT, but this is just a sort of what are the biggest couple of things that do it. The state and local tax deduction is by far the most important force that pushes people into the AMT. Okay? About $90.9 billion of AMT preference items that were being added into AMT liability in 2006. About 3 times that in 2007 as we ramp up to the no exemption, to the lower exemption. People also lose the thing under the income tax called the personal exemption, which is a floor amount that you can subtract out. You don't get to take that under the AMT. You get to take the regular AMT, the AMT exemption. Well, losing your personal exemption and your personal deductions for dependents, that forces people into the AMT with some probability. That's another one of the problems that's mentioned with the AMT. If you have 2 kids under the regular income tax, you get 2 extra deductions. We could have an interesting discussion about the structure of family tax policy and whether it's fair to have different levels of dependent deductions and things like that. But there isn't any of that under the AMT. The AMT is basically one size deduction for single, one size deduction for married, but it ignores the number of dependents. That has the result of pushing more people in larger families into the AMT regime, because those are people for whom the income tax is lower as a result of the deductions that they get to claim. This is my other cartoon. This is my canonical special AMT provision taxpayer, somebody who has a very complicated financial life and is not the person who's being kicked in just as a result of the sort of state-local tax deduction or something like that. Okay, I think in the last few minutes that we have, what I want to do is to jump ahead and talk about the popular concern about the AMT and where the prospects of reform going forward are. The National Taxpayer Advocate is an office in Washington that is basically it's a citizen ombudsman who's responsible for watching over the tax system and making recommendations each year about some of the problems that emerge in the tax code. In 2005, 2004, the Ombudsman Office basically said that reforming the AMT was the single biggest challenge we faced in the income tax code. It was the #1 problem, bigger than the problem of the IRS not answering the phones or whatever, that this was really where we had to take action. And although that's the case, broad public concern has not yet emerged on the problem of fixing the AMT. And I think it's because there still are only 4.5 million AMT taxpayers. Depending on how 2007 plays out, this may be a very different situation in another year. But we haven't seen a lot of that discussion yet. What's going to happen? I don't think we know. There's a little bit of what I'd call budget brinksmanship going on, which is at this point, the Congress has not passed any legislation that would change those exemption levels for 2007. When do they have to do it? Well, I think it's, the natural time to do it is during the congressional session this fall, before we get to the end of the year. It is possible that the IRS will go to print and start printing tax forms into the early part of the next year, and Congress might come back in early 2008 and decide to retroactively change the rules for 2007. That would get us into a situation. We've had these situations in a couple of other recent years where people are actually getting early tax forms from the IRS that turn out to be superseded by subsequent revisions, and that, needless to say, creates a lot of extra complexity in this process if you have to make sure you download the right version of your tax software or other things like that. So all of that's going to be very tricky to play out. I think that there is probably a sense in Washington that fixing the AMT is something that does need to be done. And that, of course, sets up a whole bunch of other interesting political shenanigans, which is trying to figure out what you can, if there is an AMT fixing bill, what else will be attached to it, what other parts of tax reform will go along with it. And basically what's happening at the moment is the chairman of the House Ways and Means Committee, Charlie Rangel, is basically saying, I think we should think about holistic reform and fix the AMT as part of a broader approach to dealing with problems in the tax code. The Senate, where Senator Max Baucus is the head of the Senate Finance Committee, is coming with a much more focused, let's just deal with the AMT and we'll let the other stuff ride. And it'll be interesting to see where the two of them come together on this. I suspect there will be some serious discussion within the next few months of just these issues. And then, of course, there's the question of what the president will sign. Whether the president regards whatever compromise comes out of the Democratic Congress as an appropriate bill to approve, and I'm not sure where that will lead. So I don't have a very good crystal ball for how we're going to deal with the specifics of the 2007. What I do want to say a little bit about is the broader question of what do you do to try to fix this tax? Where can you go? Yes, sir.
So have you considered the model where if the AMT had been adjusted for inflation, how many people would be affected? Would it
Yes.
still be a small number?
Yeah, great question. Let me see. I think I have a slide here that shows you this. Yeah, this is, OK, so let me answer in a particular way. This is, again, the Joint Committee on Taxation figuring out what would have happened if in 1986, when they enacted the Tax Reform Act of 1986, they just indexed the AMT for inflation then. Okay? And that would mean that in 2006, we had about 2.6 million AMT payers, and it would rise to peak at about 3.6. These numbers are easier for me to read than for you in 2010, and then drop down if the old law returns to less than 1 million until about 2015. So the indexation, now this is indexing at the 1986 levels, right? Which means you'd have a much higher threshold today. But that would more or less have solved this problem. It would have relegated the AMT all the way along to a small tax that was just affecting a relatively modest part of the population. Yeah. OK. If you're going to try to fix this thing, what do you do? It's like there are lots of decisions, build or buy, lease or buy, sort of wreck and start from scratch or renovate. You have the same kind of questions with respect to the alternative minimum tax. You could either try to repair the thing, or you could just repeal it. Okay? And sort of your initial instinct is, OK, this sounds like a set of issues here. Why not just repeal it? And the answer is it costs money. And in Washington, or just like in your own household, right, that's a problem. How much? If you repeal the AMT completely, it would cost about $1.2 trillion over 10 years. So repeal is not an operational plan on its own. It has to be repeal plus something that will backfill the big loss of revenue under the federal income tax. Because unlike 2001, when there were serious discussions taking place of whether it was appropriate to reduce the share of federal taxes in the economy, today, 7 years down the road, looking out at growing entitlement burdens for Social Security and Medicare in the latter part of the next decade, there seems to be, and with a different House, party in power in Congress, likely to be much less discussion of let's just give up another $1.2 trillion in federal revenue, and much more discussion of what are we going to replace it with if we go forward. Okay? There's an interesting question. There's a there's a concept that's used in budgeting in Washington, which is revenue neutrality. And essentially what you're supposed to do is, and you sometimes hear words pay-go, pay as you go, so that if you propose a new expenditure program, you have to either cut an existing one or find a tax that you're going to use to do this. Which is why, for example, in the discussion we've just had about this S-chip bill, some of you may have heard that there was a plan to expand children's health insurance and put a $1 a pack tax on cigarette packs at the federal level, right? Why? You needed to put the two things together to satisfy these things called pay-go rules, which means that you have to be able to pay for what you're doing. And it's not that this was the particular moment to rethink tobacco taxation. It was that provided a convenient way of getting approximately the amount of revenue that was needed to fund the S-chip bill that was being discussed. Okay? So if you think about the problem of proposing to eliminate the AMT, the question is, how do you tell what you need to pay for? Do you need to pay for literally repealing the entire tax? The question that we wrestled with a lot during the 2005 discussion of this tax reform panel was, what's the right baseline? Okay? What should you assume taxes are going to do in the absence of AMT repeal? If you should assume that every year Congress is going to enact another patch, then effectively you're in a world where the AMT is collecting not that much revenue. So if you repeal it, it's not that expensive. But that's not the law. The law says the AMT kicks in at its full glory starting in 2007. If you have to work with the statutory language to say what do we need to basically fill in terms of revenue, then you have a much bigger problem because you have to find the whole 1.2 trillion. Okay? And I think reasonable people could disagree as to what the right baseline to use in that context is. And it sort of suggests that the concept of revenue neutrality, which seems like a rather cut and dried idea in principle, is actually somewhat more open-ended than you would have otherwise guessed, because there's a political dimension to figuring out what realistically would happen as you went forward. You have to think that through before you can be sure exactly what you're going to do. Okay. If you decide that repeal is too expensive and you can't think of a good way to do the repeal, what you then are left with doing is some sort of repair. And there are basically 4 parameters you can play with as you think about repair. Okay? You can change the base of the alternative minimum tax, which means maybe you could take some things out, you could put some things in and make them taxable. You could change the rates. You could decide to make 28 higher and make the base narrower, so you took some people out of the system but charged more to those who paid it. Okay? You could fiddle around with all those things and have an AMT which looks different than the current AMT. You could also play around with the individual income tax, the regular income tax, right? And sort of invariably you would have to do something like that because if you didn't confine your attention to fiddling just with the AMT, you would have to go after the regular income tax to try to make up some of the money. Okay? I'm leaving out the possibility of some radical reform of the tax system, like the adoption of a national sales tax or something like that to pay for the AMT, on the grounds that those sorts of changes would just be even bigger than whatever would go on here. But you could decide to include more things in the individual income tax base. Okay? For example, you could decide to eliminate the state and local tax deduction from the regular income tax. That, it turns out, would pay for most of what you needed to repeal the AMT. Wouldn't help those of you here in California that much, but it would manage to balance the federal budget. You could also decide to change the tax rates. Okay? You could decide that the 35% rate was going to go higher on high-income households, and that would be a way, for example, of trying to pay for some of what was involved with respect to the AMT repeal or reform. Okay? Now, this is a place where I want to just jump in for a second with what economists think about when they discuss which tax policies are good or which ones are not. And the first important, there are 2 laws. I figure there are a lot of people here who probably have backgrounds in physics and things. So the first law of tax economics is that taxes do distort economic activity. Okay? Except for something which just goes out and says, at the end of this hour, we're going to announce that anybody who came to the talk pays $200 to the Google Charitable Foundation. That's an example of a tax which would have very small distorting effects, because once you've decided to come and we've gotten your names and you're on the video, right, there's nothing you can do to avoid the tax. You can't change your behavior at this point to escape. So while it doesn't seem very fair, your office mate who decided not to come doesn't pay this, and why did that happen? And really this wasn't that valuable a talk, you say. It wasn't worth the payment I had to make. Right? The one thing I can guarantee you is that a tax which taxed you on something you did before would have minimal distortion effects today. Although, it might matter the next time Hal invites a speaker. You might think twice about coming along to watch, right? So we call this the dynamic consistency problem, which is that once I tax you once on something you did in the past, it may be more difficult for me to convince you to do similar things in the future, even if I say, promise, I won't tax you this time, okay? When you recognize there is these distortions, right, that higher marginal rates, for example, will lead people to think about working less. They will lead them to think about saving less. They will lead to other behaviors. They will do less. They may do more charitable giving when their rates are higher. There's a whole panoply of responses that may take place as the tax rate goes up. And tax economists like me spend our careers studying those responses and trying to understand them. Okay? The second law, however, is very, very important for this purpose, which is that the amount of distortion that takes place, the amount of efficiency cost that one imposes on the economy, goes up not with the level of the tax rate, but with the square. Okay? And essentially what matters is that, because you're sort of combining a change in behavior with a change in the amount of tax that you have to pay, you're kind of multiplying two things together, which are like the tax rate, and you end up discovering that the burden on the economy is quadratic. Okay? Well, what does that tell you if you think about the kind of tax policies you'd like to put in place? If you're concerned only with the amount of distortion, what you want is tax policies which have relatively low rates as best you can manage them. But of course, if you're going to have to raise a certain amount of revenue, that's not free. How do you put in place a low rate policy? You have to put it over a broad base. Okay? So you want a relatively large base for taxation with a relatively low rate. Good example to understand this is think about a sales tax, right? Very familiar, easy to think about tax. You can imagine putting in place a 5% sales tax on all of the goods that people consume. Literally everything, right? The food in restaurants, the services provided by lawyers and accountants and doctors. We don't have taxes that are that broad in most states at the moment. But you could conceptually think about that tax. Compare that with a tax which raises the same amount of revenue, but only taxes half the stuff. So that services are exempt, food in restaurants is taxed, but food at home is not, right? Things like that. You're suddenly going to discover some distortions that are greater with the 10% tax because you're going to end up pushing people further away from eating in restaurants, further away from consuming the taxed commodities, and further in the direction of consuming the less heavily taxed things when you have that sort of a structure. Okay? The broad base, lower rate will have lower economic distortions associated with it. But there's another trade-off here. Okay? Because the reason we often go to narrower bases in the tax code is not just because we're trying to maximize distortions, right? Our policymakers are not after that. It's typically because there's some other objective. And the other objective is very often distributional gains. Okay? People are concerned about who pays the taxes. And in my simple example with the sales tax, the problem with putting a tax on everything at the same rate is that food consumed at home, electricity consumption, healthcare, those tend to be goods that are consumed more at the bottom end of the income distribution than at the top, right? The share of the budget that goes to those items in low-income households is higher than the share of the budget for high-income households. The result is that if you're trying to use your tax policy to achieve two objectives, trying to be as efficient as possible, but also being mindful of the distribution, you end up with this challenge of how do you trade these things off? And it's very hard. Right? I don't envy the task of being the policymakers who have to do this because you have to try to figure out how to balance the two things. The result is that you're trying to think, how do I take on a little bit more distortion to get some distributional gains? And that's not something where economists can solve the problem. Right? There are, economists are a little bit like engineers in many ways, which is that there are some problems where if you can define the problem for us, we can actually give you an answer. We can tell you what the right solution is. Hal Varian's textbook is the Bible for learning how to do the kind of problem solving that economists are good at. And the problem here is one of political economy, okay? Because you have to decide what the trade-offs are, and it's not so clear how you think about these different components. Okay? The last thing I'll do is just to show you a little bit of the kind of different things that one could do if one thought about base broadening, and then I'll stop and take any questions that are left. If you thought about the AMT repeal option, okay, and going that way, one way that you could do AMT repeal is you could take the regular income tax and raise the rates across the board by about 15%. Okay, now that's not to take your 35% rate to 50. It's to take the 35% to 1.15 times 35. right? Or to take, the 25% rate would go to 28.75. So that would basically do it. That would raise enough revenue, even with the years with big AMT liability, to be able to achieve revenue neutrality. If you had to do it with the top brackets alone, so change the 33 and the 35% brackets, of course the differences in rates would need to be larger to manage to make up for the revenue need. You could also do base broadening. Okay? And this is something that the tax reform panel actually tried to use as the primary vehicle for paying for AMT reform. But it's tough, okay? Because where are the places that you would broaden the base under the regular income tax to try to collect significant amounts of revenue, right? And there are all sorts of little provisions that you can say, let's close this loophole or let's close that loophole. And in many cases, it seems like it's an okay idea to do some of those things. But they typically don't have lots of revenue associated with them. The places where there's real money are in places like the state local tax deduction, the non-taxation of employer-provided health insurance, the home mortgage interest deduction. And as soon as you start to say, we're going to play around with those key deductions, you run into a political firestorm. Okay? The tax reform panel, which involved a lot of people working very hard, we had a great staff making recommendations for tax policy. We basically said, let's put a cap that's tighter than the current cap on home mortgage interest deduction. Let's include part of employer-provided health insurance in the tax base, and let's disallow the deduction for state and local taxes. And that basically guaranteed that the home builders and the mortgage industry, the health industry and all the insurance providers, and all the politicians who represented states that had large state and local taxes were deeply opposed to the proposal from the moment it arrived. Okay? Now you might say, why didn't you figure that out before you started? And we had sort of talked ourselves into the view that we were here to tell people what a desirable, efficient tax system would look like, and that keeping rates low and bases broad was the way we were going to go. What I think we learned from that exercise was that the political economy is a very, very important constraint on what you can do with respect to tax reform. And it's a big challenge to be able to move forward in that regard with finding something which is acceptable and looks attractive but solves the problem. Bottom line, to be able to make real headway on the AMT problem, you have to have a lot of people who think the AMT is a big problem. Okay? Because you need some counterbalance to the set of people who are going to think that whatever you do to fix the problem with the AMT is a big problem. Okay? And there's no doubt that to really get the revenue you need in some significant way, there's going to be a big constituency that's concerned with that. Okay? The lesson I'd leave you with, though, is as you think about this, and as you as consumers of economic policy, as readers of the popular press on these things, think about the kind of reforms that might emerge, avoiding situations where tax burdens are very, very high at the margin, where people are facing high marginal rates, is one of the key touchstones to return to time and again. And it's not just a lesson that one learns from the economic analysis in the textbooks. It's something that policymakers around the world have actually, I think, embraced to a large degree. One of the overwhelming trends, in addition to the percolation of Google as a search engine throughout the world economy, is the fact that many, many countries have decided that very high marginal rates are not the way to go, at least on some parts of the population. So even in countries in Scandinavia where tax rates were as high as 70% on high-income households as recently as a decade ago, those tax rates have come down significantly to 50% at the top. Much of continental Europe, below the Scandinavian countries, has come down to ranges closer to where the US is today. So much change in those dimensions, and I think that reflects in part a recognition that when the tax rates are really high, you get a lot of evasion, you get a lot of avoidance, you get a lot of distortion, hard to collect that revenue completely. The challenge, of course, is without those high rates to achieve the kind of things that we'd like in terms of a distributional outcome, and that's not an easy problem to solve. Thank you all very much.